What's up, everybody? Welcome back to the Free Toaster News Pod, the show for marketers and consumer lending. I'm Carlos Caro, your host, and I'm here with Toaster co-founder Nick Madrid. Nick, this week's story is one of those regulatory developments that kind of sounded dry on the surface, but I think it's anything but. Klarna just filed an application with the Utah Department of Financial Institutions and the FDIC to become a bank. They're calling it Klarna Bank USA, and it's going to be a Utah-chartered industrial bank. They're not alone. Since December, Klarna has been the ninth major fintech to file for or buy its way into a U.S. bank charter. So this is following Affirm, PayPal, Upstart, Revolut, Bonk, which is new to me, but they operate out of the Netherlands. They're moving into the U.S. and they've been in lots of other European markets. Mission Lane, OppFi. The list just keeps growing. So the OCC saw 18 de novo charter applications in 2025. That's nearly equal to the previous 4 years combined. And then Claros Group's Michelle Alt expects roughly 25 more de novo applications this year. So today, we're going to talk about who's filing, why the window's opened, and one genuinely weird thing I found buried in a Morgan Stanley report about Klarna. And I know we're going to get to this, which is what it does to the competitive map for consumer lenders. So my big question is, why is everybody running for the regulatory door? And as we dug into it, and we covered this in the newsletter this week, so a decade of renting is ending. So we've seen now 10 plus years with this model where we have a sponsor bank, whether it's WebBank or Cross River, rent out their license and charge fees for the oversight. So Klarna's done $91 billion in the U.S. since 2019, all of it through partner banks. So three forces, I think, that have converged here. So funding. So everyone knows insured deposits are the cheapest, most stable way to get funding in consumer lending. So if you fund through receivables and securitizations and warehouse lines, deposits materially cut down your cost of funds. To quote Michelle Alt, you get access to low-cost funding in the form of insured deposits. That's pretty cool. Second is control. So a charter removes the sponsor bank sitting in the middle of every loan. Their fees, their oversight, the concentration risk. Max Levchin framed Nevada ILC filing as a play for regulatory clarity and not near-term growth. I found that interesting. And I've actually worked with a lot of lenders that work with sponsor banks, and that friction of getting approval to do everything is very real. So I've seen that firsthand. And then we have an open door here. Under the prior administration, most fintechs had no realistic shot at a charter. Now the FDIC has conditionally approved ILCs for Ford, GM, Stellantis, Edward Jones, and the OCC also has greenlit Mercury and Nubank's U.S. unit. So we have live precedent for the first time in 15 years.
Yeah, but I don't think the window's it isn't unconditional. Community banks, trade groups are pushing to freeze ILC approvals. There's a Senate bill to close the ILC loophole as they frame it. And the OCC publicly warned in June that it will balance materially deficient applications. Reviews typically run, 12 to 18 months. So today's filings may be decided by a different FDIC board in a potentially different political environment. And also like strong, well-capitalized monoline lenders, they're likely to get through, but very thin applications may run out of the clock. So it's also interesting, I think, as we were talking, is like who hasn't filed yet that we expect to file. Chime is basically pre-announced this back in April. CB, Chris Britt, co-founder, CEO. So that one feels like a matter of when, not if, he publicly stated. It's also interesting with Chime, there's two sponsor banks today. One is Stride Bank, one is the Bancorp Bank. And I hadn't been looking for a while, but I recently brought it up. And the Bancorp Bank's total assets is dangerously close to 10 billion. It's like 9.9 something. And that's incredibly important because the Durbin Amendment has a 10 billion threshold and that exemption. And so once you hit that, you no longer get the debit economics that are so crucial to Chime. So clearly that's front of mind for Chime. Then you've got Robinhood and Wealthfront. These are giants wearing software costume, but they're really they earn a lot of net interest margin. A huge portion of the revenue is already interest income. And the banks are everything. They're banks by all intents and purposes, but just the paperwork, at least yet. Walmart-backed OnePay is expanding aggressively. Dave and Current are staring at the exact same partner bank margin pressures that push Chime to the edge. On the SMB side, Ramp and Row have to be feeling the heat now that Mercury got its own conditional approval. Nobody wants to be the last one funding at wholesale rates while a direct competitor takes deposits. Even Cash App is a wild card here for us, right? And I think that's where it explains the pace of all of this. Nobody knows if this window will stay open past this administration. There's the real now or never type of energy. So if you wait to see how the first wave plays out, you might be flying into a different FDIC board, and who knows what will happen. I want to dig deeper with the Klarna paradox that you brought up. But first, a quick pause to thank this week's sponsor, Bulldog Media Group. Bulldog specializes in connecting consumer lenders with less than perfect borrowers, a massive underserved market that takes real precision to target and get right. They bring 25 years of financial service marketing experience, delivering qualified leads through affiliate marketing, targeted email, and data-driven acquisition strategies built for exactly this audience that we're talking to. If you're a lender looking to scale, these are your people. The link is in the show notes. Okay, so the Klarna paradox that you brought up is so interesting, and it's been bugging me all week as well. So what caused all of this was a recent Morgan Stanley report dated March 5th. It actually was a summary of Klarna's presentation at JP Morgan's Global Technology, Media, and Communications Conference. And there's a passage in there that seems on its face to contradict this entire bank filing that we're talking about today. Morgan Stanley writes, and I'm paraphrasing closely, is that the Klarna repeatedly emphasized it fully intends to be a, quote, spend-centric business and not a lending-centric business. And the revenue mix backs it up, right? Merchant fees were about 53% of total revenue in 2025. Interest income only was about 27%. Management is, in their own words, quite comfortable with that composition. So here's my question. If you're telling investors over and over and over, we're a spend business and not a lending business, why on earth do you need a bank charter? The whole value proposition of a charter is lending infrastructure, insured deposits to fund loans, direct payment rails, exporting rates. Why go through the 12 to 18-month regulatory gauntlet for a business you claim isn't your business? And here's the kicker for me. Morgan Stanley themselves flagged this tension. In that same note, they say that even though the interest income mix probably won't inflict near-term, quote, the vast majority of these incremental profitability generation is driven by Klarna's U.S. fair financing expansion. Higher take rates, interest income, gain on sale, which as they put it, is intrinsically lending. So the narrative says spend, the profit engine says lend. Which one is this charter for? What do you think?
Yeah, no, I mean, I think the narrative and the economics, I think they're allowed to disagree. It seems like they're doing so here. So, look, I think this whole spend-centric thing is a story for the multiple on the business. This has been, if you've been following like fintech investing, fintech lending, VC, you've probably noticed that the multiples these lenders get on their revenue isn't anywhere close to what like the Squares of the world get when it's more of a spend driven business. So I think there's an optics play there. But I mean the reality is though their business is more short term lending, and there's ways to construe a short term loan in the context of like e-com as spend, right? Like you show up, you buy a plane ticket, and you finance it in 4 payments, and that you can call that a spend-oriented business. And it's easy to say it's not lending because there's no APR and there's no interest rate, but there's a fee to the consumer, whether it be a consumer-based fee or a merchant-based fee. So I think it's really kind of short-term lending in disguise of spending. That's my take. But if you're going to play Wall Street optics and get the best of both worlds, I don't see a reason why not to. Another point here is like merchant fees don't need insured deposits. So the fair financing, the longer duration, interest-bearing installment loans, those do. That's the reason why they might get a charter. I think we need to watch what they're building. So the mix can stay spend-centric on the revenue line, while nearly all the incremental profit comes from lending. So I think both things can be true. Maybe that's what Morgan Stanley is pointing at. Um, so a charitable read on what they're saying. I think deposits as a funding backstop when securitization markets seize up. So I think Lending Club has demonstrated that they care about this, plus the regulatory clarity and removing the sponsor bank risk. So that's worth it, even if the lending stays a minority of the revenue, which is what the story says. I guess a less charitable read would be the spend-centric framing is like wallpaper over a lender that's tired of paying their fees to their sponsor bank.
Sure. So maybe we should zoom out away from Klarna a bit, because I know this is where you think the real story is for our audience. Let's just forget all these individual filings. What does a world look like where the fintech tier is deposit funded? Like, what does that actually look like for the competitive marketplace? Because it feels to me like the ground is shifting underneath every non-bank lender that's hopefully listening to the show, or even if they're not. How do you think about that?
Yeah, no, and I think we should look at the Mission Lane example here. To me, it's the cleanest example. I think we covered it a little bit in the newsletter, but so I guess let's just first kind of lay the landscape here, and we're going to be talking about subprime credit cards here for a second. Although the analogy may expand to other domains too, but subprime cards is interesting because it's been historically like fragmented. There's been like kind of two types of players. You've had the Capital Ones, the Credit Ones, the Merrick banks that have had the bank charters. And by the way, Capital One didn't start that way. They kind of evolved into a place where they had the bank charter. They started out as a monoline credit issuer for a very long time. So you had those three players, and then you had the Mission Lanes of the world, the Concora Financials. There's a group of lenders that have built scale over the years, but have never had that bank charter, so that they've been operating as kind of non-bank lenders. And this filing from Mission Lane is interesting because it tells me if the world is heading to a place where all the subprime issuers have bank licenses, all of a sudden, what used to be an option, like you used to be able to compete as a non-bank lender or a bank lender in subprime card. If everyone has a bank license, now it's going to be really tough, right? Because they're going to have a major cost advantage on you. They're going to have a brand advantage on you, a distribution advantage on you. So I think this could be like limiting new entrants and competition at subprime card. So I don't know if the OCC is going to look at this or what's gonna happen there from kind of a competitive dynamic. But there's enough of these players that maybe non-competition is not a concern. From a consumer perspective, this feels like a good thing, though. Consumers used to pay, or still do pay, 35% APR sometimes, because structurally it's been very hard for a subprime lender to convince the FDIC to get a license. I actually happened to do some research back in like the 2020, like the COVID-ish era. I had recently left Capital or Credit Karma, and I was looking into, hey, what businesses do I want to start? Because I knew I wanted to be a founder and to start some businesses, and a subprime credit card business was one of those things I looked at. And back in that era, based on everyone I talked to, they told me the odds of getting an FDIC license was near zero. And I explored acquisition routes. I explored de novo. I kind of looked at all the available paths to getting a charter, and it was everyone that advised me told me it was damn near impossible and that I should stop wasting my time. And it's funny to see now that 6 years later, these things are flying off the shelves. So I think the market's changed considerably. I think for the better in general, but I do worry that we might be in a place of like the haves and have-nots, because if you don't lock in your license during this administrative era and things change going forward, then I don't know what that does for the health of the fintech economy. So I guess those are some of my overall takes, Nick.
Yeah, I'm picturing Oprah. Everyone gets a bank. You get a bank. You get a bank. You get a bank. It's like literally the visual image in my mind right now. Cool. Okay.
I wish I could get one of them, Nick. If I could stick my head out and take one of them. I'll happily indulge.
I want you to put it on your vision
Yeah.
board once we're done with this recording. I want you to put that on there, okay? Okay, that's been great. Okay, and I think this sets us great for what we're doing on September 23rd. This is a shameless plug for the Affiliate Marketing Summit for lenders and publishers. And the reason why it's important, because this is the type of discussion and dialogue we expect to have through our programming that's formal, and then through our semi-structured and informal networking. It's an incredibly good group of individuals. Big thanks to sponsors for the summit, which is Experian, Engine by Gen, and Prism Data. There's so much to do here. And like, it's this ditch all of money 2020 type of vibes. This is hyper curated, really well received. Day one, Exploratorium in San Francisco. And then for a smaller group that's actually almost selling out, like we actually have fewer than 15 spots now. When we published yesterday, we had fewer than 20. For day two, this is like pure networking, pure relationship building. We bus everyone in this nice bus with Wi-Fi up to Sonoma, a great lunch, great experience, some stuff didn't happen there. So like, anyways, would love for everyone to check it out. Events.thefreetoaster.com. Obviously, there'll be a link in the show notes. Would love to see everyone there.
Nick, I also related to the event. You're going to appreciate this. And I actually might have sent you some of this over Slack earlier, but maybe for our audience, I found this interesting. We have this process where you request an invitation to the event because we're trying to keep the room very curated. We're trying to balance the right mix between publishers, lenders, and like, let's call it like the fintech ecosystem that supports the industry. So we're being really thoughtful about the ratios. That's why we're asking everyone to first apply. And we've recently let a bunch of people through. So they came in very quickly. We said, hey, you're in. Here's the link to register. And a pattern I've seen with these is that it takes sometimes several weeks for people to get the registry done. And I was always curious on like why that was. And I got a very tangible example from one of our readers on why. And she is pitching her CEO on day two. So she wants to attend day one, but she also wants to be a part of day two. And that's why it's taking extra time, because like there's internal conversations happening there on like, should I go for just day one, day two, etc. So it's always good to know the why behind why sometimes things take longer than you think they should. But yeah, you're right. I think we have something like, it might be closer to 10 seats on day two left. But we'll bus people from SF. We're going to be leaving around 10 a.m. is it? And we'll be back around 6. So it's a business day. You'll be out in Sonoma and back all before dinner. So super excited about that.
Awesome. And as always, the full breakdown of what we discussed in the publication from yesterday, the charter wave, who's filed, mission lane, deeper dive, Upstart math on why they're getting a bank charter. They're going to save $150 million a year. There's so much there. We'll link those to the show notes. You can also see it at thefreetoaster.com. And if this episode was useful, please forward it to one colleague, one friend, your mom. It all helps. We all appreciate it. So thanks, everyone.
Awesome. See you next week, Nick.
Thanks, guys. Bye.